let's get started here. So today we're proud to have Paul Marson here. I apologize, I did it again. And from Lombard Odier, and he has nearly 20 years of experience in investment management, starting out at places like JP Morgan, then Goldman Sachs, and finally moving up to Lombard Odier. And so he's here today to talk, he's prepared to talk about where the world economy is going and what that means for potential investment management. And it is a really, by definition, it's a very timely topic. And I think there's really a lot for us here to learn, if nothing else, in terms of what's actually going on in the world today. So with that, I would like to turn the floor over to Paul. Thank you.
My background, I studied graduate economics myself at Cambridge, and then worked as an economist at the Bank of England for a number of years. And then for the Bank of England, worked at JP Morgan. I was a managing director at Goldman Sachs for a number of years, and now I find myself working in a Swiss bank. So it's a really interesting career progression. Now, I've got lots of slides. Believe me, it's 7 o'clock in the evening. If we go through 80 PowerPoint slides, I'll probably be asleep before you will. There is nothing worse than PowerPoint. I hate PowerPoint. It's dreary and boring. But if I have to, I will use the slides. And you will be here at 10 o'clock and 11 o'clock probably, because it will take many hours to go through 80 slides. There are lots of them. So what I like to do is I'm really happy to talk about anything you want to talk about. Now, I have done a lot of academic economics myself, so I've kind of done all the sort of study stuff that you've done. And it's interesting, that you won't find any stochastic calculus in here. Arrow de Breuil isn't in here, that kind of stuff. All that kind of stuff is interesting within a master's program, but you won't find it in these materials. So what we're trying to do, what I'm trying to do, is try and take the intellectual framework which you're being given. Because a program like this is designed to give you an intellectual framework, a series of mental models. And I remember when I was your age, when I was doing my master's program, it was trying to take the mental model that I'd been given and translate it into some kind of evaluation of reality. It was quite a challenge. I really struggled for quite a long while to translate what I'd learned into a reasonably coherent, a reasonably cogent view of the world. And what does this tell me about the world that I see? How can I comment on the problems and the issues that I see? Because if you're like me, when you study economics as a graduate student, if something happens in the world, your grandmother always asks you, can you explain this to me? Why have these banks failed? Why is the central bank raising interest rates? And your mother will ask you questions, and your auntie and uncle will ask you questions. And it's amazing how often you really don't know the answer. You kind of think, I can write down some equations, but my granny won't understand the equations. So how can you sort of bring it together in a sort of a mental framework to sort of think about how the economy might work? So that said, as I said, I can talk about the slides, but you don't want me to talk about the slides, believe me, you don't. So what I prefer to do is for you to ask questions. What are the issues or the questions on your mind you really want to ask? And have either felt too embarrassed to ask in a class or not had the opportunity to ask in a class? What are the questions your grandmother would ask is the issue. What are the issues? When you read the newspaper, when you watch the TV news, when you think about what's going on in the world economy, what's happening in Europe, what's happening in China, what's happening in the emerging markets, what are the issues and the themes and the questions that come to mind? So your chance to ask me those questions, we'll make a list and we'll go through them. If we have a slide which is relevant, we'll use a slide. And I'll give out the pack at the end. You can have it. There's lots of very detailed analysis. Now, I should say at the beginning, I'm an economist, but I'm really not an economist. I'm an economist, I'm sorry, who doesn't really like economists much. Not the kind of thing you can say. I'm an economist who doesn't really see the value in economics as trying to be predictive and trying to forecast the future. I don't like forecasts. There are no forecasts in this material. None. I think forecasting is a fool's game. And I also think that it's irrelevant broadly. The way the economy interacts with asset prices is not what you intuitively think it is. It's not through a forecast. So what we do is we do a lot of evaluation of the environment that we observe. Given the environment that we observe, the variables that we can measure, how can we interpret that set of variables in a way to give us a reasonably sensible view of the world? So it's evaluative rather than forecasting type of material. But it's very intense, very detailed. So who's going to lead us off with some questions? What are the issues?
Do you think it's possible to unwind the Fed balance sheet?
Is it possible to unwind QE?
Yeah.
Good question. Interesting question. Okay.
Oh, I mean, just basically to let the economy work on its own rather than sort of manipulating.
I'll talk about that. I think, yeah, whether it can let the economy work on its own is one thing, but also you have a second issue, which is the actual mechanics of unwinding QE. QE is a vast experiment. Personally, I think the theoretical underpinnings for quantitative easing are very weak, and the practical problems of unwinding it are enormous. I used to work as an economist at the central bank, and believe me, it's a practical nightmare. So we can talk about that. More questions? Come on, there must be more questions here. Any more? I'll go through the slides. Let's start with QE. That'll raise more questions. Everybody knows what QE is. Do you know what quantitative easing is, how it works, what it's a policy designed to do? What is quantitative easing? Tell me. You're an economist.
No, I'm a banker.
You're a banker. What is quantitative easing?
Basically, since the interest rate is at zero and cannot be reduced even further to stimulate the economy, the central banks are buying treasuries and long-term government bonds in order to inject cash into the economy.
And how does it work?
Well, it actually doesn't work because those money are still in banks' reserves, right? Rather than go into the real economy through credit.
But if it doesn't work, why did they do it?
To raise inflation expectations.
To raise inflation expectations. Kind of interesting thing. Okay. Think about how QE works first of all. First of all, QE is not a money printing exercise. As a central banker, they are not printing money. If you look at the definition of money that you would think about as a central banker, it would be the monetary base, which is the required reserves of the banks, the excess reserves of the banks, and the notes and coins in circulation. Really, that's all the central bank has any chance of control of. Now, if you look at the notes and coins in circulation, so money in your pocket, in your bag, the rate of growth of the notes and coins component of the US monetary base since the crisis started is about 7% a year, annualized. In the previous 35 years, the rate of growth of the notes and coins component of the monetary base was about 7 or 8% a year. So no different. So the idea that the central bank is flooding the system with cash is simply not correct. That's the first point. What they do is they basically credit the account of a bank at the central bank. So you create, as you said, excess reserves. You raise the monetary base by creating excess reserves. So you've basically driven interest rates down to zero, and you're crediting the account of a bank with cash. So I'm giving you $100 million of cash, you're giving me $100 million of securities. So your balance sheet as a bank hasn't changed. It's more liquid, but it hasn't grown. And so therefore, you as a banker are sitting there with a balance sheet full of cash, which basically starts to destroy your return on equity, destroys your earnings, destroys your profitability. If you're a bank with large amounts of cash on its balance sheet for a long period of time, you won't be a bank for very long. You go bust. So QE is a policy of creating pain. What QE is trying to do is basically force that cash along the curve. So if you think about and this will get to your question about how you reverse it, this is part of the problem. If you think of the spectrum of assets as cash, treasury bills, government bonds, equities, say, houses and other real assets. So you've got a spectrum. Now, generally speaking, you should have a risk premium. As the duration of those assets increases, then you should have a risk premium. And so what quantitative easing does is drive down the risk premium. You force people from cash into treasury bills, from treasury bills into bonds, from bonds into equities, and eventually equities into real assets. It's a process of creating pain. Now, someone has to hold the cash that's put into the system. Someone, somewhere, has to hold those reserves, that monetary base. And so what happens is that the relative price of all of those assets adjusts until such time, in equilibrium, that monetary base is held by someone, somewhere. And so the Fed now has a almost $3.5 trillion balance sheet. $1 trillion of that is notes and coins in circulation. $2.5 trillion worth of reserves and excess reserves. Now, normally, that level of reserves and excess reserves, prior to the crisis, for example, reserves and excess reserves were, let's say, 65 billion US dollars. Today, we're talking about 2.5 trillion US dollars. So a vast increase in the size of the monetary base and the balance sheet of the central bank. So when you put all of that cash in, the way QE works is the idea is that you drive up asset prices, and when you drive up asset prices, you increase people's wealth, and you get wealth effects into spending. Now, if you study econometrics, you do all manner of econometric estimation. And there are lots of things you can do which are much more impressive than a simple scatter plot. But if you just simply plot consumption against wealth on a scatter plot, you get a pretty random plot. There is nothing there. The idea, and it's not just the Fed that holds this view, but the Bank of England and other central banks, the idea that quantitative easing works by driving down risk premia, driving up asset prices, driving up wealth, and stimulating consumption, really, as far as I can see, has next to no empirical support in the literature. Now, you can correct me if I'm wrong, but I read a lot of the academic literature still. And I see very little empirical support in the literature for the idea that you get that effect. Now, you've got people up here on your founders, Don Patinkin amongst others. You look at some of the great names in American economics. Milton Friedman for some might be one, and he might not be for others. But Milton Friedman was pretty clear in showing you that people consume out of permanent income. People don't really have a high marginal propensity to consume out of equity wealth. They smooth their income, they consume out of permanent income. So the idea that transitory changes in equity wealth can stimulate consumption to such an extent that you can lift a $16 trillion US economy off of the floor really has next to no empirical support.
But if people believe that there will be a deflation in the economy,
If there will be
there will be deflation in the economy in the future, will we see a wealth effect?
How does that work?
If I expect that prices will be low tomorrow, I might postpone my spending.
Yes. Well, think about, there's an example of that. Which country has that kind of example? Think of a country that's like that. Japan. Japan has been in deflation largely for the last 20 years. Now, in Japan, has there been much of a wealth effect because of deflation and quantitative easing effects? I would argue no there. If you look at Japanese household balance sheets, Japanese households hold 55% of their assets in cash. They are the most cash-rich household sector in the industrial developed world. Japanese households have less than 10% of their financial assets in equity. So if the Bank of Japan boosts quantitative easing, puts liquidity into the system, does the same thing, and they're doing it now, I would argue in Japan, the effect is going to be relatively de minimis. Because effectively, what they own is cash, not equities. There is no wealth effect to be had out of a reduction in the risk premium between Japanese bonds, cash and equities. So I don't think no is the answer to that question. Now the issue.
You said that QE is not money printing, but where does the Fed take its liability side to increase assets?
Oh, they can basically create liabilities. You just basically credit an account. You credit an account at the central bank. So, for example, you're Ben Bernanke, I'm JP Morgan. You can create monetary base. That's the beauty and virtue of being a central banker. Press the button, 1 nanosecond later, $1 billion appears on my balance sheet. Now, simple. Central banking is easy in the modern day. You don't need a printing press, you need a laptop. You just tap away, you create liabilities very quickly.
So when you said printing, you meant literally the printing press.
Oh, yeah.
I think that what you just described is what we would normally call printing.
Oh yeah, no, I'm thinking printing press, because your grandmother thinks that they're printing money. My mother asked me, where are they printing all these new pound notes, these new £10 notes and things? And I had to explain to my mother, they weren't actually printing new banknotes. That's not what sort of money printing is. It's a balance sheet effectively a balance
It's
sheet
more like
transfer.
a newspaper slang, but
Yes,
the
yes.
meaning.
Now the issue with QE is kind of interesting. When you come out of it, let's have a look at it. Because we've got a lot in here about QE, which you'll recognise. There's a lot of detail here. I can send the exam paper afterwards. You can read it, I'll send you an exam paper. You see, it's... okay. So here, these are the interesting bits about quantitative easing. Everybody knows Milton Friedman. We talked about it before. Money times velocity equals price times output. MV equals PQ. Simple quantitative theory of money. Everyone knows that. You should do. Okay. So if you think about it this way, on the vertical axis here, we've got 3-month Treasury bill yields. And on the horizontal axis, I've got the velocity of circulation of money. And what you see here is classic textbook picture. This is exactly what you would expect to see. As interest rates come down, the velocity of circulation of money diminishes. In that nice sort of fashion there, you see a very clear reduction in velocity. Money is a hot potato. When interest rates go up or are very high, the opportunity cost of holding money is high, you pass the money quickly. When interest rates go down and go down to zero, the opportunity cost of holding the money is small, the money circulates less quickly. So you see a very clear relationship between interest rates and velocity. If you take the same equation and you sort of turn it around slightly to get liquidity preference. Liquidity preference is the relationship between base money and nominal GDP. So basically, the amount of money it takes to support each unit of GDP. And then you have the same thing on interest rates. So this picture here and this one here, they're basically the same. But this is a slightly more interesting way of showing it. If you look at where we are today, we're pretty much basically out here. It takes about pretty much 18 cents of monetary base to support every unit of US GDP. We are at record levels of liquidity preference. We've never been here before. Okay? Now this is the point. These are the combination. This is interest rates and liquidity preference. So this line shows you where combinations of equilibrium exist. Effectively, at this level of interest rates, this is the level of interest rates which is required for people to hold that amount of money relative to GDP in equilibrium. So coming out of QE, problem one. What's the first problem, the obvious problem? What happens here if the Fed raises interest rates?
It has to basically decrease the balance sheet, otherwise the inflation picks up.
If the Fed is going to raise interest rates here and try and normalize monetary policy, that's where you have a massive problem. Now, getting into QE is real easy. You can go into QE, you can do $85 billion a month every single month ad infinitum. There is technically no limit to the size of a central bank's balance sheet. It could grow ad infinitum $85 billion a month. You can do it in small increments, no problem. But when you reverse the policy, that's where the problems appear. Because if you start to raise interest rates, when you raise interest rates, what happens to the velocity of circulation of money? It goes up. So think about, if you've got an inflated, expanded stock of monetary base, and you raise interest rates, or you try to normalize interest rates, velocity starts to rise. If the left-hand side of your equation starts to go up, the right-hand side of your equation goes up. Now, that could be mixed between output and prices. I would bet that there would probably be at least a reasonable element of prices in that. So you have the paradox here that badly handled reversal of QE could be inflationary. My mother thinks that creating all this money is going to create inflation. And I said to my mother, well, actually, if they raise interest rates, that's more of a worry in terms of inflation than if they're just printing this money. You have the paradox that tighter monetary policy is inflationary. Bizarre. Most people don't think about it that way. Tighter monetary policy is inflationary because an inflated stock of base money starts to move around the system and has to be held in equilibrium. Now, the issue here is that if the Fed were to normalize Fed funds, let's say, if you take Fed funds up, say, 2.5% to 3%, if you take Fed funds up 2.5% to 3%, then the decline in liquidity preference that you see means that the monetary base, the Fed's balance sheet pretty much, has to decline by a couple of $1 trillion. So they can put $85 billion a month in incrementally, but when they reverse it, they have to take it all out in one big go, an enormous go. So the reversal of QE is hugely, hugely problematic. Now, what do you think happens if the Fed doesn't want inflation expectations to rise, and so therefore reverses the policy with a substantial reduction? Because you can see here, to go from 0.18 to say 2% and say 0.08, you need a massive, massive shrink of the Fed's balance sheet, unless you're going to get inflation. If the Fed doesn't want inflation again, what happens if the Fed shrinks its balance sheet by that scale in one go? You are going to decimate the bond market. I mean, can you imagine if the Fed starts taking that kind of liquidity out of the bond market in one go? You take $1 trillion out of the market. Because the interesting thing is that that's what the Fed would have to do to remove the liquidity. Because if you go to the Federal Reserve Bank of New York website, or the Fed board website, you can see the Fed's balance sheet. The Fed doesn't own a lot of Treasury bills. The Fed doesn't own a lot of two-year notes. The Fed owns lots of longer duration bonds. And so they'll start selling lots and lots of long duration bonds very quickly to reverse this policy if they're going to do it successfully. Now, if the Fed starts selling $1 trillion worth of long duration bonds, the rise in bond yields you've seen over the last 6 to 9 months is going to be modest compared to what you would see after that. So there is a big, big problem of unwinding QE, which I frankly don't think central banks have really thought about. But sorry, can I just say the other one point? Getting to my other point is that the idea that QE doesn't work. Again, simple scatter plots. I can send you spreadsheets with regression equations behind this, but the result's the same. I believe in Occam's razor, nice and simple. This is, for example, the 5-year change in the monetary base, annualized, versus the 5-year change in the velocity of circulation of money. Look at the equation. It's kind of perfectly linear. Effectively, QE is pushing on a piece of string. You push in a certain proportion of monetary base, the velocity of circulation declines proportionally. QE doesn't work. I really don't believe that QE works. I'm a strong believer that QE doesn't work. The reason why I think they did QE is because the first rule of central banking is to preserve the integrity of the deposit base of banks. Those of you who studied banking as part of your economics know that we live in a fiat money system. There isn't enough cash in circulation to satisfy the demand for bank deposits. If we all ran to the bank tomorrow to get our money out, there wouldn't be enough cash. So you have to preserve the integrity of the deposit base of banks in a fractional reserve banking system. And that's why you do QE, just to stop the banking system collapsing. You don't do QE to stimulate growth. And in fact, you had the Fed balance sheet go to $3.5 trillion. US growth from the spring of 2009 to today has been 2.1% real annualized. The long run trend is 3.2.
But what growth would be if there hadn't been QE?
I don't think growth would be any different. That's my point. Because it doesn't have any effect. This is exactly my point. Here you go. This is the nominal equity return year on year versus 1 year forward real GDP growth. And this is the same thing using real versus real. So you can mix and match, cut and paste. You can torture the data. I mean, we're all economists in this room. We're good at torturing data. And we can make it scream in agony by doing all manner of things to it. But what you see is that the effect of the rise in equity prices, which the reduction in the risk premium engineered, the effect of that on real GDP is pretty trivial. In fact, I think it takes a 30 to 40% rise in real stock prices to get 1% real GDP growth. So had they not done QE, I don't think it would have made a lot of difference, to be honest, as long as they preserve the integrity of the deposit base of the banks. Which is why reversing QE, I don't think will have a lot of effect on the economy. I think it will have an effect on asset prices. If the Fed reverses QE very quickly, now tomorrow they're going to announce tapering. Let's say it's 10, 15 billion a month, like most people expect, down from 85 by 10 to 15. That's going to have modest effect. That's already priced in. But if the Fed were to take that tapering further and go down to nothing and then start to unwind its balance sheet, I think equity markets would fall sharply. I think the US equity market is held up by QE. So the effect, if they didn't do it, would be that the equity market would be a good deal weaker than it is. Would growth be substantially weaker? Not really, I don't think. Not really at all. You see the same thing in Japan. The Japanese are now trying it. 5-year annualized growth of the Japanese monetary base versus the 5-year annualized change in the velocity of circulation of the monetary base. Complete offset. A 1% rise in the monetary base gives you a 1% fall in velocity, no net effect. And you see this in every major economy that you look at. As an ex-central bank economist, it's quite sad to think that central banks can't really do much. They really can't do much with quantitative easing. This is why I said at the very beginning that I think the theoretical and the practical empirical underpinnings of QE are weak at best. Weak at best, frankly.
Just continuing your point on potential increase in interest rates, how do you think the firms like BlackRock that sitting on tons of bonds are feeling now? Are they swapping, hedging, or
I would imagine they're probably
maybe Lombard Odier has some position on long-term bonds also?
We've been underweight bonds for a little while. We've been underweight government bonds for a little while, so it hasn't really hurt us. But a specialist bond manager, will be hurting here. With bond yields rising as much as they have. But remember, interestingly, bond yields were rising before the tapering talk started. If you look at the cumulative increase in US Treasury yields, if you date back to when the Fed started to talk about QE, the rising rates started before that. So it wasn't just QE tapering which caused yields to rise. But yeah, people will lose a lot of money on bonds. You own a lot of bonds and yields normalize. If you think about it, if everything was normal, what is normal? If everything was normal, the economy was growing, let's say 3%. Let's say inflation in normal terms is 2.5%. So 3 plus 2.5 is 5.5. Some kind of term risk premium. Normal, say that, normal 10-year bond yields in the US, 5.5 to 6%. Double where they are today. A doubling of US 10-year bond yields is a problem. And incidentally, is a big problem for the Fed. Because the Fed's balance sheet is I don't know, 60, 65 times its capital. The Fed is one of the most leveraged banks in the world, interestingly. So the bank which, if it weren't part of the government balance sheet, the bank that we wiped out first would be the Fed.
Yeah, but then this account will change, which, you know, the credit treasury account.
Oh yeah, sleight of hand.
I mean, technical is economical, but...
Yeah, sleight of hand. A central bank isn't going to go bust, but I just think it's quite amusing that you have a central bank which is that leveraged, that can be that leveraged.
As soon as the dollar is the main reserve currency.
Yeah. So it's quite amusing, the idea that they could go bust.
So to your point, that it's very difficult to unwind quantitative easing.
Can I just say one point? Sorry to interrupt. It's interesting as well. I'm not the only person who says this. Have you all heard of Charles Plosser? Charles Plosser? Everyone knows an economist called Charles Plosser? Very famous American academic economist. I think he's the chairman of the Philadelphia Fed. But you should read, he wrote a piece on this about 2 years ago, saying that each quarter point increase in Fed funds needs to be associated with about a $300 billion reduction in the Fed's balance sheet. So Plosser's written about this. The Fed knows about this. At least one person in the Fed knows about
Back in
this.
2010,
Yes,
3 years ago.
3 years ago. Plosser was writing about this.
And my question was, is it, like, given the difficulties to unwind QE, do you think that the best possible scenario for, like, US and continental Europe is just like sort of Japanese scenario, like 20 years, no growth, low inflation, but basically kind of muddling through, as opposed to some sharp increase in rates with some completely consequences?
Well, yeah, I mean, I've long been in the camp of no inflation. I've been saying for many years. When the whole crisis started and liquidity and QE started, I've been saying for many years inside Lombard Odier before that I don't think the world has any inflation problem. And I also famously said as well, I don't think central banks could create inflation if they really tried. They create asset price inflation. That's easy. But I don't think they could create much shock in day-to-day inflation if they tried. There's one very simple reason. I kind of think about the world in very simple terms. You people are in the real economy, where you make cars and furniture and clothes and things. You make real things and get your hands dirty. These people are in the monetary economy, where they wear nice suits and dresses and they go to work and sit in a nice office. They don't get their hands dirty. They get paid double what you get paid. Now, in your part of the world, if you look at investment, global investment is at about 26-27% of GDP. It's at the highest level since the early 1980s. So the supply curve in your world is elastic, horizontal. Okay? In your world, you can't go home this evening, dig a hole in your back garden and open an oil well. You can't open a lead mine at the end of your grandmother's garden. Yeah? Supply of financial assets and monetary assets is pretty inelastic over any decent time period. And so when you put liquidity into a system, that liquidity has to be held in equilibrium somewhere. And I think that the total mix of real and monetary assets, prices adjust to hold that liquidity in equilibrium. If you put lots of liquidity into the system, what happens in your world? Prices go up dramatically, but no change in output. In your world, output goes up dramatically, no change in prices. That simple picture is the story of the last 15 years in 30 seconds. What we've seen is massive inflation of bank balance sheets causing banks to collapse. We've seen the fastest growth globally in the post-war period. Central bankers focused on this and said, look, inflation's really low. It's the end of the economic cycle, as Gordon Brown said. Haven't we done a wonderful job? And all the time there was this festering problem over here on their balance sheet which collapsed the system. So inflation always appears from monetary policy, but it's a function of the relative supply elasticity between the two sectors of the economy. I think that's what we're seeing. And the strange thing is that central bankers are making the same mistake again today. You know, keep pumping asset prices, keep inflating bank balance sheets. There's no inflation. US inflation is at the lowest level since the early 1960s. Eurozone core inflation is at 1%. There's no inflation anywhere. I don't think they could create inflation if they tried, really, other than a clumsy unwind of QE. A really clumsy unwind of QE with a significant, huge rise in interest rates, that would raise inflation expectations very sharply. But even there, I think that would be difficult to translate that into actual price dynamics. But you see, just interestingly with QE, you can see how this is Japan. So this illustrates when QE does and doesn't work. You've got deposits. This is from March 2001 through January 2004. This is when the Japanese first tried QE. And it failed. They tried it once and it failed, and then they gave up. So I calculated what the real interest rate was on deposits, what the real 10-year bond yield was, and what the real expected equity return was at each point here. You can see that quantitative easing works when you have a term risk premium. It doesn't work when the risk premium is negative, as it is here, and when it's zero most of here. QE today in Japan is working to drive up asset prices because you have a term risk premium. A big, big difference. This is when QE works, this is when QE doesn't work. But the Japanese, I think, will find that QE doesn't do any more for them than it did for the Americans or the British. It'll inflate asset prices, I have no doubt about that, equity prices, but I don't think it'll solve any economic problems. Not really done in the US. 2.1% real GDP growth, double-digit effective unemployment rate. That hardly seems to me a great payoff to a massive balance sheet expansion.
I'm sorry. What do you think about expectations? Is actually QE can shape expectations of firms to invest more, for example, or to invest less? And so this actually can drive the economy.
Okay, interesting idea. Walk me through how it works. I'm kind of one of these people that I kind of nice and simply, walk me through the steps of how that would work. How you think it would work.
Well, actually, if we look at in Japan, we can see that economic agents, companies, they are excited about this new attempt of QE, and they invest more in production facilities, they invest more in real economy, so the GDP is starting to grow.
Well, possibly. I mean, GDP collapsed in the middle part of last year, and I think you've just had kind of an error correction process to bring it back up. But Japan's problem is real GDP growth in Japan has been pretty impressive for the last 5 years. Not much less than Western Europe, about half the rate of the US in real terms, better than the UK. The Japanese growth is sort of fine. Real growth, it's nominal growth which is the problem, and the declining tax collection in Japan, which is the big, big problem. But if you think about investment. Right. This is investment in fixed capital, so gross fixed capital formation as a share of GDP by region. This is developing Asia at above 40%. This is developing countries broadly at about 30 to 35%. This is the world at about 25, 26%. And that's the advanced countries, in which Japan will be included, down below 20. Now, first point is that global investment growth is at a close on 30-year high. That's kind of point one. Secondly, if you look at developing Asia, which is to a large extent China, they're spending almost half their GDP on investment. So the world is awash with investment capacity, productive capacity. In their real economy, the supply curve is elastic, almost perfectly flawlessly elastic. Why would Japanese companies want to invest aggressively into an environment where you have the highest level of investment to GDP for decades, and where effectively that investment is going on in much lower cost areas than Japan really can ever be, even with a weaker yen? So I'm not convinced that Japanese companies are going to go out and invest any more than American companies went out and invested. American companies have been relatively modest. People have wondered why American companies haven't been investing more. I think this tells you why. This really tells you why. The world is awash with investment, and you see it in China. Here you go. This is consumption as a share of... Wasn't me, honest. Didn't touch it. This is consumption as a share of GDP in China. This is investment as a share of GDP. When the Chinese are investing almost half their GDP, I don't think the Japanese are going to take quantitative easing and some kind of rise in expectations as an opportunity to invest more. I think what you're seeing in Japan is exactly what you saw elsewhere. The term risk premium is steep, the term risk premium starts to flatten, that raises equity prices, that gives you some kind of wealth effect. But as I said earlier, it's about 8%. 8% of household assets are in equities. 55% in cash. Japanese householders, I don't think are going to benefit from it. So I don't see QE working brilliantly well in Japan either, really, to be honest. No.
What do you think about the effect of QE on commodity prices?
Well, again, it's the same thing, isn't it, really? If you think about global commodities, what's been the source of... Well, let's start again. Take the demand for commodities. Break it into parts. So think about the transactions component of demand, the speculative component of demand, and the precautionary component. Now, the speculative component is basically hedge fund managers and fund managers. So let's kind of forget that. The precautionary bit is people who are worried about Americans bombing Syria and Iran closing the Straits of Hormuz and all that kind of thing. Let's forget that. Just think about the transactions bit. You buy commodities to make things. If you look at a generic basket of commodities over the last, say, 5 to 10 years, the proportion of the increase in demand that came from China is between, depending on what commodity you look at, between about 60% and maybe 130%. But certainly it's the dominant force in the marginal increase in the transactions component of demand for commodities. And on the basis that supply is still relatively elastic in the commodity side of things, it's not surprising that when China was growing rapidly, commodity prices were growing quickly. Now, is that QE? I don't know, you might argue that was QE, I don't know. I think it was something a bit more interesting. It was a Chinese version of QE. The green line here shows you annualized Chinese growth on the right-hand scale. So you can see the economy is growing at 11 or 12%. Then the crisis hits. Lehman crisis hits, the world falls apart. Growth collapses. The red line is the growth in the asset base of Chinese banks. Now, the Chinese banking system is exactly the same size, roughly, as the US banking system. In an economy broadly a third the size. So the Chinese banking system is way, way bigger in proportion to GDP than the US banking system. So what the Chinese banks then did, because they're part of the government balance sheet, they pumped the system. You can see here that in that period around the time of the crisis, 2008-9, Chinese banks grow their balance sheet by 50% of GDP. 50% of GDP. Think about that. That would be like US banks putting in 8 trillion US dollars. 4.5 trillion euros in the Eurozone. 750 billion pounds in Britain. Unbelievable sum of money. Enormous. This is monetary stimulus. This is QE and monetary stimulus on a scale you can't imagine. Growth responded as you'd expect. Chinese banks give free money, companies invest more, growth. Then you can see that the banks slowed the rate of growth of their balance sheets, and Chinese growth has fallen commensurately with that. So yes, QE did have an effect on commodity prices back in this window, but it's gone. It's passed, it's not there anymore. Liquidity always creates inflation somewhere in something. But it's a question of just the elasticity. And commodity supply is inelastic, that's where you get inflation. This is very interesting. This is, so you can see, Chinese thing here is interesting. The orange line here is the US current account deficit as a share of GDP. And it's inverted. So this is the US deficit getting bigger. You can see Chinese growth accelerating. Then you see the crisis starts in the United States. The US current account deficit collapses. Chinese growth collapses. In response to the collapse in growth, the Chinese government pumps the balance sheet of its banks like a steroid shot. Chinese growth accelerates. When the steroid shot wears off, Chinese growth converges back down. The Chinese economic miracle is basically fueled by the American deficit. When the American deficit disappeared, the economic miracle disappeared. You see, I'm really cynical. One of the things you have to do, if you're a student, is kind of question things. I believe in sort of trying to be as evidence-based as you can. What is the evidence? What is the proof? What is the empirical testing for this view to really understand how things work, rather than just take something as a given? And when you look at the Chinese miracle, I don't think there really is any miracle, to be honest. If you put that much bank credit into the North Korean economy, it would grow.
So what?
But actually there is a causality problem. We don't know what actually goes first. Is it demand for loans for the companies that would like to invest, or like ability of banks to put money into these companies? I mean, if there is no demand for loans, so the banks, for example, here in Russia we have a problem that corporate loans are growing quite small. So, but it's not about that banks are not ready to give loans to companies. It's just maybe the case that companies are not willing to take these loans because they couldn't invest them.
In the Chinese case, there's an interesting story in the press. I read a lot of newspapers, South China Morning Post, to get some stories about China, and I read English versions of the Moscow Times, and just to get sort of local flavour of what's going on. A couple of weeks ago in the Chinese press, there was a story about a Chinese province where the provincial governor was arrested because they'd overstated GDP. They basically doubled the size of their income. Because in China, if you're a politician, the government transfers money to your part of China in proportion to how well you're doing. So the system incentivizes you to inflate your growth. And so therefore, if you're a local Chinese politician, and you're going to call the local bank and say, well, actually my brother owns a steel mill. I think we need to have another steel mill. So the bank will lend to build another steel mill next to one existing steel mill which is producing steel that nobody really wants at a price that is unprofitable. So I think the Chinese system is where the loans are pushed into the system rather than demanded. Although I think you're right, there is a point that I think on any reasonable Western accounting basis, I can't think of many, if any, Chinese companies that are viable using Western accounting standards. Very, very difficult. So you've got a whole raft of Chinese companies which are on life support with bank loans. The interesting thing here is that, look, you had that surge in bank lending and growth surged in the economy. Here, you had a big increase in bank lending again, growth did nothing. The marginal return starts to wear off. I think this lending here was by and large to Chinese companies to keep them alive, rather than anything else.
So what's going to implode then in China? It sounds like it's artificial growth.
Yes.
Is what you're suggesting.
I think China is artificial growth. So if you think about China, I think about something as simple as a Cobb-Douglas production function. Simple undergraduate economics, really straightforward, basic Cobb-Douglas function. Labour, capital, Productivity, multi-factor productivity, simple. If you have, let's say, 25 million Chinese leaving the farms to go to the cities each year, you have a massive increase in labour input. If you have banks which are willing to expand their balance sheets at a third or more of GDP annually, you have massive capital. You don't need any productivity, multi-factor or individual factor, to get any growth in that system. It's just basically pumping the system full. And I think that's what you have now in China. You have a system which is essentially leverage. It's just built on vast amounts of leverage. If you look at private sector domestic credit relative to GDP, people tell me the Chinese have no debt. It's simply not correct. You look at the data, China's in here. China is more leveraged than Italy, Australia, Greece. China's more leveraged than Greece. Unbelievable. It's more leveraged than France, it's more leveraged than Germany. The Chinese corporate sector is more leveraged than much of the major industrial world. If you take the government and you add up their debt in a correct Western fashion, I would guess that the Chinese government debt to GDP ratio is probably on a par with something between Portugal and Greece. The idea that China is not leveraged, I simply don't believe. You know, whenever you see rapid growth, you should be sceptical. Whenever you see rapid growth anywhere, the first thing that comes to my mind is who's paying for it? Who is paying for that growth? Because growth, you know, if you go back a century or two, when scientists talk about the ether and energy moving through the ether, if you talk to physicists, you don't have growth appear out of the ether. Growth has to be financed, it has to be paid for. And in China's case, the growth is financed out of massive, huge debt. You have a mountain of debt underpinning the Chinese economy.
What's that? You mean US debt or internal debt?
Internal debt. Massive.
This kind of virtual debt, maybe this is the same story like Japan, for instance. They have very big debt, but it's inside the Japan, so there is no any problems with investors and so
But it's not, that's kind of interesting. Yes, a good point. But it's not the fact that it's inside that's the point. Because, you know, if you look at Japan, for example, just over 90% of the government debt is held by Japanese. People use that as an argument that they don't have a problem. Japanese are fine. But you know and I know, where is the price of debt set? Is it set at the average or at the margin? It's set at the margin. At the moment, the marginal unit of debt in Japan is sold to a domestic investor. And with deflation, the implied or expected real return on a Japanese government bond is attractive. They'll keep buying it. But let's say tomorrow, Japan is now running a current account deficit. It has a shortage of domestic national savings. Gross investment is bigger than gross savings. Suddenly, the marginal buyer of Japanese government debt is not a Japanese housewife, it's a foreigner. Let me make you a proposition. You're a foreigner, I'm a foreigner, we're all foreigners. You're a foreigner. I'm going to offer you debt at 80 basis points, so 0.8%. The country's workforce has declined 1.4% over the last year and is now at the same level as it was in the mid-1990s. It's in structural decline. The total debt of the government plus the total banking system assets are, well, total government debt is about 25 times tax receipts. The potential growth rate is barely 1, and the debt to GDP ratio is approaching 2.5 times GDP. Interested? No. The domestic bit doesn't matter in those circumstances. And that's the same thing in China. China is running a current account surplus. And what you find is that countries can... This is a sweeping statement. This is not strictly textbook true, but it's a generalization. Countries with current account surpluses generally have much more freedom and can do more than countries with current account deficits. Because you as a Russian have more allegiance to the Russian government and supporting your own country than I do as a Briton. I have more allegiance to Britain than you would have to Britain. It's a natural thing. So when you have a current account surplus, domestically you can finance things and you're fairly immune to the world. When you run a current account deficit, that all changes. Because I, as a Briton, frankly, I really don't care a great deal about China. You know, it's interesting and it's great, fine, but I'm not going to provide my savings to the Chinese government on the terms in which they might want them. Likewise, I'm not going to give my savings and savings of my children to the Japanese government on the terms at which they would want them. So I think at the point where China starts to run an external deficit, and I think they will do in probably the not too far distant future, then they're in trouble.
What would trigger that, going from surplus to deficit?
I think there are a number of things. I think first of all, remember the Chinese working population declined last year for the first time. So the Chinese, if you think about that Cobb-Douglas production function, L is declining. Now, not many people move to China. You don't see many foreigners in China. Similarly in Japan. These are racially quite homogenous. You walk down the street in New York, you see British people, Americans, Russians, Chinese, every single possible mix. You walk down the street in Tokyo or Beijing, you see Japanese and Chinese, the occasional foreigner denominator. So structural growth decline is an issue. I think the issue also comes about, if you think about the current account decline, it comes about because of the Western deleveraging. It's the issue that if the West deleverages, here you go. This is the current account balance of the Western developed countries in red and the emerging countries in blue. And they're listed up here. Russia's in there. Okay? Let's separate out. This is China, Russia and Japan with a combined surplus. So you can all breathe a sigh of relief. You're safe for the time being. So Russia, China and Japan are okay for the time being. This is Brazil, India, Indonesia, Turkey, South Africa. These are the countries which are currently in trouble. You read the newspapers? Little emerging market crisis. It's those countries. Deficits matter. This is the Western, UK, US, France, Western Europe deficit. These countries are deleveraging. If they don't deleverage, they're going to go bust. You know, they have budget deficits, which implies still rising debt ratios. So the Western countries have to deleverage. If they deleverage, their deficits shrink. What happens to the surplus somewhere else? It has to fall. And so you've seen the surplus in those countries fall sharply. It's more than halved in those countries. It's down 70% in Russia. My idea would be, I think you'll see this red line come down again, as you see this green line continue to go that way. So the trigger for lower developing country surpluses is smaller developed country deficits. And the reason why you have to have smaller Western developed country deficits is because if we don't, we're going to go bust. Every surplus has a deficit. Every asset has a liability. So wherever you see surpluses, look for the corresponding deficit.
So anyway, we can assume that China has kind of artificial growth, but anyway, we see great dependence on China around the world, and so now it's trying to be the biggest world trader in export and import. So when for instance Russia quite heavily depends on different types of manufacturing production in China. So what could be next after the possible slowdown in China?
Okay. What's the next growth area, region?
So I mean that everybody around the world used to import something from China.
Where next? Okay, interesting. Where next? Good question, very good question. Now, China at the moment is speeding up slightly because they're pumping more credit in. They're putting a little bit more credit into the system, so you're seeing a modest acceleration, but much lower growth rates than you've seen historically. And I think the Chinese growth rate going forward will be much slower than they've seen historically. China has to keep growth to a certain level to prevent social unrest. and they will do that. I do think Chinese growth is vastly overstated. The Chinese way of accounting for national income, Richard Stone would turn in his grave if you can see this. I mean, frankly, it's a strange way of accounting. So what comes next? It's kind of interesting. There's a very good book actually to read if you're interested in these kinds of things. I often get asked that question by clients. What comes next after China? Where's the next sort of region that's going to take over and grow? And there's a very good book called The Birth of Plenty by William Bernstein. William Bernstein is a neuroscientist in the United States who happens to write investment books. Actually, do as a hobby. Interesting guy. But he wrote a very good book. It's a very easy to read book. It's not full of lots of complicated mathematics that you have to spend an hour translating each chapter. So you can read it on the train. It's a train book, a bus book. But the ideas and principles are interesting. And what he looked at the kind of institutional economics framework. What makes growth? Think about Switzerland. I work for a Swiss bank, and I don't want to offend the Swiss, but Switzerland has mountains, snow, cuckoo clocks, and chocolate, broadly. But the Swiss are very wealthy. If you go to Africa, Botswana has enormous mineral wealth, tremendously fertile soil, great population, but Botswanans are poor. Why are Botswanans poor and the Swiss rich? Switzerland also is landlocked, can't go anywhere. The ingredients for a growth cake, if you were to make a growth cake, essentially Bernstein, and this comes from the institutional part of economics. You think about things like scientific rationalism, capital markets, transportation, the rule of law, property rights. Why did the Industrial Revolution happen in Britain when it did, in the early 19th century, late 18th century? Was it that the British suddenly discovered something that man hadn't known for the previous 1700 years? No. It's because everything came together in Britain in the late 17th, early 18th century. Late 18th century, early 19th century. And what it was, effectively, is that you had English law, property rights, you had Dutch financiers coming across the channel into London, so you had financial markets, you had transportation, a large navy, sea transportation to move goods around. You had scientific rationalism, you had universities and education. Everything came together in one place at the same time, everything. And I think the next area where that happens is, I think, Africa. I do think for the next 50 years, it'll be Africa. If you read a very good book on globalization by Jagdish Bhagwati, you heard of Jagdish Bhagwati, trade theorist? If you read trade theory, Bhagwati is a trade theorist. And he wrote a book on globalization, very interesting. And he's got an interesting picture in that book, I think it's in that book, where he shows GDP per capita in Asia versus GDP per capita in Africa in 1970. And in 1970, Africa was doing really rather well, and the Asians were really rather poor. And then in the following 40 years, the lines just cross. It's like a cross. Africa went down steadily, Asia went up steadily. And I think you're going to see African catch-up. I think Africa will be the next area. Yeah, they have a workforce. If you look at some of often the argument is that Africans don't have an industrial culture and so on, and they're not as efficient workers. But if you look at some of the more interesting recent research on that, if you adjust for the capital stock, African workers are no more or no less productive than workers across much of Southeast Asia. African workers are efficient. Yeah? You have capital markets, you have a surplus of savings in these countries, they have surpluses. I think they just have lacked all those ingredients at one same time, the rule of law and property rights. So I think they will come together. I think that's the next wave, it will be Africa. You had Britain from sort of, say, 1750 through in the 19th century. Then the baton passes to America, and then you see Japan and Singapore and the Asian tigers, and then you see China and Vietnam. And I think we go around to Africa next. Do you know something called Balassa-Samuelson theory? Balassa-Samuelson? Heard that? It's part of the whole Balassa-Samuelson idea that you pass from region to region. I think Africa's next. I like the idea of investing in Africa. So when you graduate, move to Africa and start a business.
Also read some simple ideas of repeating trajectories, for instance, that steel per capita in Asia and mainly in China are very low. So, and for instance, analyzing the past of South Korea, for instance, we can assume the same story and expect maybe 7 to 8% of GDP growth for next 20 years, for instance, and
No. I think this is kind of part of the whole BRIC thing, that China will be the world's biggest economy in 20-something years. I don't believe that. Again, another very good book to read. There was a book by a guy called Kahn. I think his name was Hermann Kahn. He was a German physicist. He left Germany around the time of the war, went to work at the Hudson Institute in the United States. He wrote a book called The Emerging Japanese Superstate. I can give you a list of books to read if you like. The Emerging Japanese Superstate is interesting. This was the BRICS model 40 years early. This was BRICS before Jim O'Neill invented the term BRICS. And what Herman Kahn did, who's Herman Kahn? Kahn was his name. What he did basically is he took Japanese growth through the 1960s and he just drew a line. And he said, well, in the 1980s, Japan will be the world's biggest economy. And as far as I can see, Japan is not the world's biggest economy.
Well, but it was pretty close, right? At some point, like in the 90s, it was like, in the US, it was like almost like a panic that, at some point Japan will overtake.
It never got close to overtaking GDP. There was a panic in terms of Japanese production methods, and the Japanese would run them over, and the Japanese would rule the world.
Yeah.
But the Japanese didn't rule the world, and they don't rule the world, and the idea that their GDP would grow on a trajectory like that was simply incorrect. And I think the reason is what I said, it's a Balassa-Samuelson idea. Success breeds failure. Success has the roots of failure inside it. Because what happens, you see it in China. When China has lots of rural workers, the Chinese economy is the domestic economy and the foreign economy. The domestic economy and the traded economy. In the traded economy, you're competing with American firms, with French firms, with German firms. You have to be really competitive. You have to be very productive and efficient. You're in the domestic economy and you're just competing with someone in the province next door. You can be inefficient, it doesn't really matter that much. Not so problematic. As you grow, you need more workers. So you pull workers from that side of the economy into your side of the economy. Drive up wages, because you can pay higher wages, because you have higher productivity and higher profitability. That drives up the price level. The rise in the price level and the rise in the wage level gives you real exchange rate appreciation. Real exchange rate appreciation kills off your trade-driven cycle.
But it's equilibrium process. It's natural.
Yeah, exactly. It's a natural process. It's life and death.
So what's the problem?
No, there's no problem with it at all. I see no problem with it at all. What I'm saying is that process you're seeing happening in China, and that's what will pass the baton elsewhere. It's what did for the British economy. There was the famous story that you could walk from one side of the world to the other on British land at one point. We ruled the world. Not anymore. The American era, the Americans are still there, and I think the American economy will stay the strongest economy in the world for quite some time to come. But I think other countries will pull up the baton because of that effect working. And the Chinese economy will grow more slowly because of that effect working.
I'm curious, I don't know if you're prepared to talk about it, but you made this sort of throwaway line about Africa. If there's sufficient respect for property rights and the rule of law,
Yeah.
what's your feeling about what is sort of the minimum level of property rights and rule of law that is important, or where is it important, or how? Like for Russia, for example.
Okay. Well, if you think, as a foreigner, if you look at the Russian, start with Russia. Russia is a very cheap equity market. If you take the Russian index, it trades at below book value, which means that much of the Russian index is trading below what you would consider to be liquidation value. Incidentally, the same could be said of Japan broadly. Very, very cheap. So Russia is a very cheap market. And somebody once said to me, Russia's kind of hard to love, easy to hate. That is that kind of a Western sort of view. Hard to love, easy to hate. And one of the reasons is property rights. The idea, you can look at it recently, and I can supply you with cases there are a number of recent cases where the interests of foreign investors in Russian companies have not been given, shall we say, the full support that they probably deserve by Western standards. So I think Russia does have a serious perception of property rights for Western investors. I speak to a lot of Western investors who would not buy Russia. They would love to buy Russian companies, but they always say to me, I just can't be sure that what I buy is mine and not Vladimir Putin's. That's the simple fact of what foreigners say. Okay? You might think it's not true, I might think it's not true, but perception is reality. Perception really is reality. Foreigners don't believe that they will be treated by the law in Russia the same way as Russians are treated. So can I just finish it? So I think the key point is that, it's kind of legal standards, property rights and whatever. It's rather like pornography. You can't describe it, but you know it when you see it. And I think property rights and the rule of law is the same thing. It just needs to be tested. There needs to be some sense of it being tested a number of times where you see that the interests of foreign investors are held in the same regard as the interests of domestic investors. And I think many Western investors have not seen that in Russia. And even with recent cases where it's not been that case.
I'm sorry. I mean, for example, what has changed for the last 5-6 years? So why? So is it the rule of law deteriorated here in Russia, or there were no such problems back then? For example, 2, 6, or 7 when the market was rolling, and everything was okay. So why then investors were not so interested in this?
So the issue back then is that the point you've described is that point there. That's the point you just described. You described the point of the peak of the current account surplus. You basically described the peak of your cycle. You didn't really need foreign capital back then. Now you need foreign capital here at the point where you have a deficit. And your own central bank is forecasting that you'll have a current account deficit in this country before too long. So there will be a deficit here before too long. That's I think, reasonable to assume. But back then, the market was being driven domestically. Growth was rampant. China was rampant. You're basically linked to the Chinese growth engine to a degree, but rightly or wrongly. China is rampant. The global economy is fueled by a massive US deficit. Russia is going to do well. Simple. It's that simple.
I mean, for example, if you look at the stock market, it's actually quite big here in Russia, but the most history of this market, the biggest part, maybe half, they were actually owned by foreign investors. So you can assume that, for example, there were less investors at that time, foreign investors at that time, than, for example, now. So, I mean, that in your case about the current account, of course, make the case, but does it actually matter for the equity market? I mean, maybe it's more important some expectations about the growth rate.
I don't think the growth rate really matters. I mean, if I'm going to invest in Russia, I'm not concerned about the growth rate. The simple thing is that on a cross-sectional basis, the correlation between economic growth and equity returns is zero.
On what time?
Oh. Let me show you. It's not growth that's stopping people in emerging markets. It's something much more simple. Here we go. Let me show you. There's a very good book by Dimson, Marson, and Staunton. I don't know if you've read that. They wrote a book looking at a century of equity returns. They looked at all of the global markets, Dimson, Marson, and Staunton, looked at the global equity markets, and they looked at the cross-sectional correlation between economic growth and equity returns. So they've done it. There's an academic in the US called Jay Ritter at the University of Florida. Ritter's done the same thing. He writes a lot about IPOs. He's done a couple of papers that he's published on cross-sectional correlations between economic growth and equity returns. Peter Blair Henry, you know Blair Henry? These are all well-known names, so they're not sort of unknown people. Henry's written papers on this as well, looking at emerging markets. We've written stuff on it. This is over the last, from sort of middle part of the 1980s through to now. We took basically the emerging and developing economy GDP growth from the IMF, and looked at it against the MSCI Emerging Market Total Return Index. You can argue about the construction of the two as though, but the result is the same. It simply is the same. The cross-sectional correlation is zero, effectively moderately the other way, if anything. So it's not growth. If I look at Russia or China or any other emerging market, economic growth is the last thing on my mind. I want to own cheap assets. In the world of investing, interestingly, in the world of investing, dull and boring is better than hot and sexy. Hot and sexy is bad. Okay? Hot, sexy, bad, dull, boring, good. Remember. Because returns in dull, boring countries are invariably better than in rapid, hot, sexy countries.
Excuse me, Paul. What do you use sentiment indicators, like the general volatility? Do you have some
sentiment indicators on investment returns?
Yeah. Where is the world is now? Whether it's time to invest or just sit in bonds?
Yeah, using investment sentiment indicators are kind of difficult. Again, I said I read a lot of academic stuff. There's an academic in the US called Meir Statman. Have you heard of Statman? Meir Statman is, I think he's at the University of Santa Clara somewhere, not a particularly big school. But he's probably published more in the field of sentiment against asset prices than anyone else in US literature. So read Meir Statman's work. And what you find is that the relationship between investment, sentiment, returns is weak at best. Really quite weak. I wouldn't tend to use it. I kind of look at it. I want to know, but I think it wouldn't be something which would be absolutely vital. So investor surveys of confidence don't really tell you a great deal about implied or forward asset returns. But read Statman's work. There's something in it, but frankly not a lot. I think there's more in momentum than you probably get. You get sentiment effects very good in momentum. So if you look at momentum effects in asset prices, you see a lot of that. So if you read stuff by people like Cliff Asness, for example, at AQR Capital, he's written lots about valuation and momentum combined. Because it's interesting, the way that valuation and momentum combine, and the correlation between the two, if you look at sort of value-adjusted momentum, it's much more powerful than just value or just momentum. So combining the two is a very powerful tool. Here's something very simple. If you take just something really, really simple, like, I think it might be in here. Let me show you. We're getting there, so you probably want to go home. Let's finish on this. What we did here, we took the US equity market. This is Robert Schiller's data. You can get this for free off the internet, off his website. We downloaded the spreadsheet. We calculated a total return index on the US equity market back from 1871 through to today. And we calculated the 10 biggest drawdowns in US market history. And they're not chronologically ranked, they're ranked in order of size. So the biggest one ever was 82%, 1929 through 1932. That's the Great Crash and the Great Depression. The second biggest was 2007 to 2009, 49%. I can give you copies of this, you don't need to take pictures of it, I'll give you a copy, don't worry. So you can see how they rank down. Now, if you construct a total return index, very simple to do on a spreadsheet, take you 2 minutes. You calculate a simple 10-month moving average. Just not even exponentially weighted, so something really simple. Simple 10-month moving average, and you plot it on a chart. So you just plot it through time. And you say, okay, I'm going to buy the market when you're above that 10-month moving average, and I'll sell when I'm below. Incredibly powerful signal, and it captures some of your sentiment things. Effectively, you're capturing sentiment within momentum. It's amazingly powerful. What you see here is just using that simple strategy, selling when you go below the 10-month total return moving average, and buying when you go above it. These are the maximum losses you suffered using that strategy. These are the maximum losses you suffered just looking at the index. So you can see that 1, 2, 3, 4, 5, 6, on 6 occasions you were down, on 4 you were up. Basically on 1 you were flat pretty much. But you find that the worst drawdown you ever suffered in the biggest 10 drawdowns in US history was 5.5%. It's quite extraordinary. You can see here, it sort of gave you a buy signal in 2009 June, 3 months after pretty much the trough of the market. In 1929, it took you out in October 1929 and took you back in August, 2 months after the bottom of 1932. You can see that it takes you back in just a few months after the end of the drawdowns. So that captures momentum effects, captures sentiment, I think.
And what was average return for that time period that you calculate?
Well, the average total return on the US equity market through time is what? Roughly 6%?
Real.
Real. Yeah, real. A bit higher in the money. 6% roughly real. But this is drawdown, so this is kind of good discipline for risk management. To avoid the big drawdowns, because you can talk about VAR models and volatility and things, but I'm more interested in drawdown. Volatility doesn't interest me. Drawdowns all matters.
A simple technical indicator.
Yeah, because you can test this. If you look at something like simple like the 200-day moving average, which people like, if you test it, it gives you lots of false signals as many as good signals. And once you factor in transactions costs, it doesn't work consistently. This really seems to work consistently. We've looked at lots of technical momentum variables, and as far as I can see, from the stuff that we've done our own work, we've looked a lot through the literature, and things like Asmus's work and others that work with him. There are really sort of two things that sort of consistently work. I think Austria did some work looking at lots of variables and found it not really work. The New York Fed published some work about 2 years ago on this as well. So what you find, that we found, are really only two things that seem to have any real content in them. And it's this, and interesting, is something called the Dow theory. Charles Dow's Dow theory from the early part of the last century. I think it's Rauenhorst published a lot of work in that, looking at that, and that seems to have consistency. Because you find technical variables that work, but they don't have consistency. And Rauenhorst's work suggests that it does have consistency in that, and there's other research in that field that shows that as well. So we use those two sort of sentimental, momentum things. But even if you take out transactions costs here, we even adjusted we apply a total expense ratio to it. Even after adjusting for that, it works. And interestingly, it kind of works across multiple asset classes as well. So we apply the same thing across US equity, Euro equity, US 10-year bonds, REITs, commodities, gold, bullion. And you get a hold, sell, and buy signal. A hold and a sell signal. Kind of works pretty well. Right, I should stop, I think.
Well done. We'd like to thank you very much for writing a presentation.
So we can send you copies.
Wonderful. So I suppose if anyone would like a copy of the presentation, is there a place they can download it, or maybe they could email me? And
We'll email you, and then you can hand it over.
Yeah. Actually, I have a copy of it. Somehow, I have a copy of it. If you'd like a copy, then you can email me at pkelly@nest.group, and I'll email you a copy of the presentation.
Paul, can you leave a list of books?
List of books?
List of books.
Okay, I'll send you a list of books as well.
Very good. Thank you.
Very good.